Today, we will be looking at all the options relating to return, inflation, and other assumptions within the software. That will include things like setting up your default assumptions, the thought process behind your assumption selections, adjusting assumptions within a client plan, all with some tips and tricks along the way. So I see a few people are still kind of coming in here, so I'll take some time with the housekeeping items before we jump in. First off, the session is being recorded, and we will send you a copy after the webinar. So what I usually recommend is if you are watching this with the intention of actually working on a specific plan or anything like that, just take the hour, try and pay as much attention as you can, absorb as much information as you can, and then about 30 minutes to an hour after the closing of the webinar, you will get an email with the recording. So then you can use that, fast forward, rewind, pause it, whatever you want to do. But while we're here, just try and absorb as much as you can. We will also have a Q&A session at the very end. So please feel free to ask questions throughout the webinar. Just a recommendation, if you are going to ask a question, just make sure you actually mark what it is you're asking about. I can't see the questions till the very end. Zoom makes me pull it up in a separate window. I can't see till the end. So if you ask a question that says like, hey, can you do that again or something like that, I'm just not going to know what you were referring to. So just keep that in mind when you ask a question. But with that, I think we are all set. So I will share my screen for everybody and we can get started. So, all right, today I will be starting in the advisor portal. This is where we're going to be spending most of today. And I do want to mention up front, we are talking about assumptions today. This has to do with especially default settings for a lot of client plans. We did actually make an update to things like our return assumptions very recently, which is why we're talking about this today. If you are a power user of RightCapital, or at least very familiar with the software, this may not have anything too mind-blowing for you. This is definitely more geared towards the newer user. But there is still some stuff in here that's helpful for everybody. Again, we did have an update that was for return assumptions very recently, so I will go over that. But generally, again, a lot of good stuff in here. So I'm in the advisor portal, as I just mentioned. Where we're going to be going for most of today is in this three-dot icon right here, and then the assumptions menu. So again, I'm in the advisor portal. This should be the first thing you see when you log in. You've got this three-dot icon, otherwise known as the More menu, and then assumptions. That's where we're going to be sitting for most of today. So the very first tab, we're going to go tab by tab here. We're going to go in as much detail as we can. So the first tab we're going to be in is the asset return tab, which I would argue is probably the most important set of assumptions to have figured out right off the bat. Again, not that the others aren't important, but obviously asset returns does touch a very important part of how this software really functions. So we're definitely going to spend a little bit of time here. So when I get to the asset return page, what you should see by default are going to be these two options right here. We'll get into what this third one is in a little bit, but your two default options should be the historical index returns and the forward-looking assumptions from JP Morgan. That's typically the defaults you'll see once you log into the software for the first time. Now, the way that these work is that what we're essentially setting up is, hey, we have all these different asset classes in the system, everything from large growth, large value, and U.S. equities to international equities, emerging markets, all the way down to cash and even an other category. All of these asset returns will correlate with whatever allocations you have for accounts set up in a client plan. So what I mean by that is when we see, hey, this is the historical index returns, and large growth has a 2% dividend, a 9.9% capital gain, an 11.9% return, 15.7% volatility, that will automatically correlate to whatever assumptions you have for a client plan. So for example, if I were to I'll open this up in a new tab. If I were to go to models and then portfolios, if I were to assign, let's say, the aggressive model portfolio to a client's account, all these percentages that we have set up for what they're actually invested in will then correlate with these numbers here. So it is very important to understand where these come from because, again, if you set up an investment account for a client in the software, in one way or another, they're going to be pulling from these return assumptions. So again, it is very important to understand where these come from. So within the assumption or the asset return assumptions, obviously there's quite a few options. We have all of our asset classes. We do have options on the interest, dividends, and capital gains for each one, and then a total return volatility displayed right here. Now, these two right here, as I've mentioned before, are the defaults for the system, right? So when you log in for the very first time, you should always see you have these historical index returns and these forward-looking assumptions. What are these? So these two actually pull from quite a bit of information. To help explain this, I'm actually going to use the Help Center article we have right here for where we're actually pulling the information on this. This is the first of a few times I'm going to be bringing up the Help Center. This is a fantastic resource for just about anything on the system. So if I'm going through this and you're confused about anything I'm talking about, usually what I recommend, assuming you can't ask a question or the webinar is already over, you're watching this as a recording, definitely check out the Help Center. Anything I'm talking about today, I can almost guarantee you there's going to be almost an entire full article talking about that in the system somewhere. For example, I'm on the asset return assumptions article, but if you were just in the Help Center, you could look up all that type of stuff in the search bar. You'll get tons of videos, articles, whatnot, referencing these. So definitely the first of a few times I'm going to mention it, but I want to make sure everyone knows where that is. So as I scroll down, you'll see that we actually have a section dedicated to the historical index returns and the forward-looking assumptions. I'm going to start with the historical index returns because it's probably the most basic. As it mentions up at the top, this is the default selection we use for return assumptions in RightCapital. And it's essentially just based on actual historical data from various market indices. So if I scroll down here, this is actually the list we pull from. So as you can see, these are the numbers we have currently for large growth, the large growth asset class. And we are actually pulling this from the S&P 500 total return index from 1975 to 2025. One important thing about this is that depending on the asset class, we will always try to pull 50 years worth of data from that asset class if it's available, unless it just hasn't been around that long. So for example, mid-cap, the furthest we can go back is actually 1995. Obviously, that's not 50, but that's the furthest back we can possibly go for that data. But at the end of the day, we are really just pulling that direct market data for all the background on these asset classes. So when you see a number like large growth, almost at 12%, it's coming from this data directly. Now, a lot of people look at that and go, well, that might be a rosier outlook than I'm expecting. Again, we are pulling from a very large span of data here. Going back to 1975, there's obviously a lot of incredible boom periods and losses in that time. We're talking about the dot-com bubble, the 2008 bubble. We're talking market crash. We're talking about the insane returns we've seen in some cases since 2020. There's obviously a lot feeding into this, and it can make some of the returns seem, in this case, a little bit extreme, which is why we also have the option for forward-looking assumptions. This is kind of how I'm going to move into this. So the forward-looking assumptions is our next default. This actually pulls from JP Morgan's long-term capital market assumptions report. This is actually available right here. So if I were to click this link, it'll actually download that report. You can see it right here, right? The full report. In fact, I can actually open this up. And we can see this is actually, again, a JP Morgan report kind of going over their thought process and their findings and why they came up with this data. Now, I'll be honest with you, I have not read this full report. I have not had time to go through all 92 pages of this, so I can't speak about it in that much detail. I don't know exactly how they got every number in here. That being said, generally, their report tends to be a little bit more conservative. So as you can see, their large growth expectation turns out to be about 6.7%. And if I go back to the software super quickly, you can actually see it's the same number reflected in here. Volatility is still high, don't get me wrong, but the returns are generally a lot lower. Now, there is some debate on this. I used to be on the support team in RightCapital. It was not uncommon for somebody to chat or call in and say like, hey, I'm just confused on the return assumptions. I'm not sure which one's going to be better for me. What do I do about that? The short answer is there is some, it comes down to what your preferences are going to be. I know not everyone likes to hear that answer. A lot of people tend to just like to hear, what's better for my client. It's going to depend is the short answer. But the reason is that obviously at the end of the day, we're trying to predict the future state of somebody's returns. That's impossible to do. Obviously, if I was here and I knew what the returns were going to be, I probably wouldn't be here at all, right? I'd be go trading somewhere making ungodly amounts of money with some trading firm. Now, that being said, it doesn't mean that we can't be smart about these two assumption presets and can use them effectively. So I've seen people that have used this software before that have never used anything but these two defaults. They always use historical index returns and they always use forward-looking assumptions, but they're smart in terms of how they actually utilize them. So the first thing you have to kind of come to an assumption on, or I guess make a decision on, is which one do you want to be your global assumption? Again, we'll get into the fact that you can make new return assumptions later, but I'm strictly talking for those people that are just kind of concerned with using one or the other. So the first thing I like to mention is that you have to choose one to be the global assumption. Is if you actually see when I click on the forward-looking assumptions here, I can't actually set these as global. What this means, what it doesn't mean is that everybody is automatically going to have these attached to their account. What it does mean is that everyone who's set currently to the global assumption or new clients will always start with this. That's essentially what it means. What it doesn't mean is they have to use it. So I'm going to transition to this point a little bit early. We'll get into this a little bit more later when I talk about things like inflation assumptions. But within every single client plan, I'm going to open a new tab here for simplicity's sake. With every client plan, you do actually have the option to change their specific return assumptions and nobody else's, right? Just strictly which one their plans are using. So as an example, I've got a plan in here. Let's go with my tried and true. I got my Skywalker plan, right? This is one of the first plans I ever built as a test case. If I jump in here, by default, this plan will be using the global assumptions I have set up in that assumptions tab, right? So my assumption currently is that the historical index returns, are the global assumptions. So when I go into this client plan and go to their settings menu, right here in the top right, what you'll notice is there's a tab for return assumptions, right? So when I jump into this return assumptions tab, what you'll actually see is that the global assumptions match up, right? So large growth is 2%, 9.9, 11.9. When I go back to this page, it's the exact same thing, right? Because this one is set to global assumptions, so it's going to follow whatever I've set up there. If for whatever reason, this client came in and said, hey, I'm really concerned about the market. I don't think returns are going to be that high. Maybe it won't be negative, but I am worried about the market. I don't think it's going to stay that way for long. And then they look at the returns in the software and go, they're way too high. These returns are ridiculous, even with volatility. I'm just getting something I don't think is accurate. In this case, you might just want to switch it to those forward-looking assumptions. You can just switch it to that, say, hey, look, you're at 6.7%. It's not necessarily bad, but it's not necessarily great either, right? It's definitely a far more conservative view. And when I save that, they will actually see those return assumptions instead. I didn't change anything in their accounts, to be clear. I'm not changing the allocation of their accounts in the net worth. Those stayed the same. But generally, their returns are going to be a lot lower because the underlying return assumptions are generally more conservative, right? So that's an instant change I can make there. Now, I will mention while I'm already here, I can actually specify these for a specific client plan. We'll get into this more in a second, but that option does still exist within a client plan. I can come in here and say, hey, I actually think they sit at a 3% dividend. That obviously ups their return. I'm not going to get too far into that right now, but that is an option. So generally, what I recommend if you're going to be between the historical index returns and the forward-looking assumptions is which one generally fits your outlook a little bit more is the one you probably want to set as your global. But that other one is always an option, and it's always an option for a specific client plan. So something I did see, as a support member was some people would, call in, they'd say like, well, it's not necessarily that I hate either of these assumptions, but I really want to make sure I'm being comprehensive with my client plan. I just don't know if I can depend on one of these. Totally fair point. Everyone wants to cover their bases. One thing I would recommend is like, look, run one assumption with the historical index returns attached to it. And then once you think you're in a good place, go into the client plan and switch into the alternative and see if the plan is still good. If one version of your plan with the historical index returns has a 100% probability of success, but when you turn it down to forward looking, it drops to like a 70 or even below. It's a good sign that like, hey, they're really dependent on market returns. And that could be a problem if generally things are going to be less rosy than perhaps the historical index returns, right? So that is definitely something important to think about. Again, not everyone approaches return assumptions the same. There's definitely a lot of preference in here, which is going to be a similar case for a lot of the other assumptions we look at later on. But the point I'm trying to drill in here is that it's not customizable. That's a double negative. You can customize these assumptions, right? You can apply one to a plan, build the plan that way, and then stress test it almost with something like the forward looking, see if they're still vulnerable. Do we have to make any adjustments to the plan if they're worried about something like that? So you do have those options available within you. And again, when I'm in a client plan and I'm adjusting these settings, it is not affecting the global settings for anybody else. It's a super important thing to mention. If I adjust the Skywalker plan, for example, to forward-looking assumptions, it is not overriding that for every other person in the plan. So that's definitely something important I want to mention. Now, all of that being said, again, I just spent a long time here on the historical index returns and the forward-looking assumptions. There's also an option for new return assumptions. So if I actually select this, what this allows you to do, it doesn't allow you to completely customize it fully. We'll get into that in a little bit later. But what it does allow you is to have kind of like your own setup for your return assumptions, right? So if I go in here, I can rename these. I'll name this the my assumptions or something like that, my return assumptions. Maybe a better way to put it, right? Something basic like that. And then I can actually go in and customize each asset class, dividend, and capital gains to something I'm more comfortable with. Now, it won't affect the volatility. We'll get into that in a little bit. But overall, I can say like, hey, they're going to have 5 and 5. That'll bring them to about a total return of 10%, right? Things like that. I can do the same for this. Maybe this is 4 and 6, still 10%. I could go down the line, settle that, press save, and then that will actually be an option. I can set this as my global. I can go back into the client plan, refresh this super quickly. I can go back to my client plan and actually choose, or there it is, my return assumptions. I can choose that as an option instead if I want that to be my default. So you do have some options here for customization. As you might be able to see, it doesn't let you control everything. For example, I'm not able to add asset classes to this. However, based on the ones we have in the system, you are able to edit those. So I have seen people that are like, look, I'm just not comfortable with these or these. Maybe I want large growth to be closer to like an 8 or 9%. That's what I'm comfortable with. You are able to set up something like that in here. Again, it's not total customization of all the asset classes, but it does allow you that flexibility. Now, all of that being said, I do want to mention while I'm saying that there is the option to actually do custom asset classes. Now, this is definitely a little bit of a complicated topic. I'm not going to go fully in depth in custom asset classes today. It's just not really the point of today's webinar, but I did want to bring it up because it is something that may be helpful for you or your firm. So I don't actually have those enabled on my plan in testing. So I'll actually show that to you within the Help Center. If I go here and type in custom asset classes, in fact, it's right there already. There's actually an article, actually a couple articles, just based on the custom asset classes. So if I actually go here, again, there's a couple warnings up front. I'll get to those in a second. But what this allows you to do is if you are actually the head of a firm in RightCapital, you would actually have the option under our platinum subscription tier to create custom asset classes, which can then be used within those return assumption strategies. This can be helpful if you want to get very, very in the weeds on the return assumptions. You want to have tons of different potential new asset classes. People who are very interested in having many, many options for things like private equity or cryptocurrencies can get use out of these custom asset classes, or if they just want to expand past the basic options we have available. So that is something you can absolutely do. Again, I'm not going to go super in depth here with everything that custom asset classes can do. The thing I really want to focus on here is that this is not for everybody. You do actually have to upgrade to the platinum subscription tier to get access to this. Part of the reason that we do that is you were actually adjusting the calculation engine used in RightCapital. You were actually, again, adjusting that base calculation engine. That affects a lot of things in the system. As such, once we turn them on, we can't actually turn them off. We would have to revert to an earlier form of the calculation engine. That can get very complicated very quickly. So it is definitely something that is important, right? And therefore, you're kind of stuck in platinum once you sign up for it. So again, I'm not saying it's a bad option, but the thing we always, always, always recommend is, talk to sales. Obviously they're trying to make a sale, but if they do not think that you are really someone who would really benefit from custom asset classes, they probably won't sell it to you because it can cause issues with the rest of your software. So again, if you are very interested in something like custom asset classes, it's worth a call. It's worth an email to sales to go over it, but they will go over all the potential pros and benefits of that subscription tier and see if it's actually right for you. Again, in most cases I've seen, you're usually able to get to what you're looking for just by utilizing the new return assumptions function already built in. Custom asset classes is kind of that extra step that can be helpful if you really need it, but you don't always need it. I know that's a long-winded explanation to that, but I do want to make sure, like, hey, don't just rush into it thinking it's going to be automatically better. It is worth having that conversation. So it's definitely something I wanted to bring up. Anyway, with all that in mind, we've spent a good 15 minutes just talking about return assumptions. We will actually return to this a little bit later, but for now, I'm going to keep us moving so we can look at inflation. So inflation is definitely a little bit less, I guess, how do I put it? Intense, I guess is the best way to put it. This is definitely a little bit more basic. What we're looking at here is effectively just, hey, what are the inflation rates we're going to use within a client plan? Again, when we're in this assumptions tab, this is the default for all new client plans moving forward, right? So when we're setting up these assumptions, the one thing I want you to be aware of is like, you're not married to these numbers, right? If you don't love 2.5% as a general inflation number, you think that's too high, but like, maybe it's the best thing for, most people, you can leave it at 2.5%. And then later on in the client plan, adjust that at will for that specific client. So again, you're not stuck to whatever this number is, but these numbers should be set to whatever you think just kind of the default should be for most clients. So in this case, our defaults are 2.5%, 2.5% for general inflation, 5% for both healthcare and education, and then 2.5% for Social Security and tax inflation. Again, this is not necessarily the best for everybody, but this is what we tend to find the best options. In fact, if I go to the Help Center here, this has a specific inflation rate article for everything in our system. It will go through generally where we get these numbers, things like that, and where it's actually used. For example, the healthcare inflation rate affects things like the retirement healthcare cost card, the annual retirement LTC cost card, and then any expenses or goals with the increased field set to health inflation. So again, you don't have to use these options. I've seen people look at the 5% for healthcare and education and go, wow, that seems really high. I don't know if I really love that number. Totally fine. You were free to set that to whatever you wanted to. I've seen people just set everything to zero and they just don't even factor in inflation. Don't necessarily know if I recommend that, but it is technically an option. But again, these can be adjusted later within specific client plans. These are just the defaults. We'll get into that part of it a little bit later. Additionally, at the bottom here, you can see, based on which selected categories, if the start date is in the future, we will inflate the value between today and the start date. What does that mean? It does say here a little bit, but ultimately what it's saying is, like, for certain cards within the system, anything checked. So for example, if goals is checked, goals with a future start date will be adjusted for inflation beginning today, right? It doesn't affect every single asset. As you can see, there is a list right there. So it doesn't affect pensions, annuities, loans, businesses, real estate income, or asset or property purchases. But for just regular things like income, so for example, if I were to put in an income that starts in 2030 and is set to $10,000 a year, it will increase by a certain amount until we hit that card. So for example, actually, I'll show this visually. So if I'm in this profile, for example, I'm back in the Skywalker plan. If I go to income and then go to add income and salary, let's say, hey, Luke is going to start this salary here in 2030, right? So let's say, we have an income coming up in 2030 for whatever reason, he's going to start making an extra $10,000 a year. If I have an annual increase set up in here of 3%, and this option is toggled, what this means is, hey, this $10,000 is going to increase by 3% between now and 2030. So it's going to be adjusted for inflation. So whatever $10,000 would be in 2030, that's what it's going to be. If you don't want it to do that, if you want it to just be 10,000 starting in 2030 and then it increases by 33%, you would want to have this option turned off. Again, this is the default for the entire system. This is not the default for the client. So if you need this to be different for a specific client, that's totally fine. It is just something to factor in. Again, you typically just want these to be set up for what's best for most people, not necessarily what's best for one or two people in your plans. So definitely important there. But with that, we can keep moving. Next up is some miscellaneous assumptions. The first three here are just some pretty basic assumptions. The first two are just the cost of purchasing and selling a real estate property. Pretty basic. I've seen some people just set these to zero, and then whenever there's a cost, there's a purchase or a sale of real estate within a plan, they just add an expense for that year with an exact dollar amount for whatever those fees are. That is totally fine. You were able to do that. There's obviously no issue with doing that. These are just built in to say like, hey, if you don't want to set that up, if you got someone who has like half a dozen properties and they're kind of switching hands all the time, you don't want to set up all those expense cards. You can kind of just tie it to whatever the value of the property is, which tends to be a little bit more, hands off. Again, you don't have to use that. You can set that to 0% if that's the way you feel about it. But just something to kind of factor in there. Next up is the expense adjustment upon the death of a co-client. So what this does by default is saying, hey, within a client plan, let's say one client passes away 5 years before the other client does. So one client passes away at 85. They're both the same age. One passes away at 85. Another passes away at 90. What it will do is say, hey, when that client at 85 passes away and leave the plan, we're automatically going to reduce their general living expenses by this. So in this case, 15% being our default. So within a client plan, if I jump back here to kind of give you an idea what that means, that doesn't affect every single expense in the system. We're not going to affect things like mortgage payments or credit cards or anything like that. That's not what we're adjusting. We're not going to adjust goals. So if they have like a vacation goal, for example, we're not going to automatically just reduce the vacation goal by 15%. However, the general living expenses, so there's pre-retirement living expenses and the retirement living expenses, these cards, these will get brought down by that percentage, right? So for example, if I just had the $8,000 here, and we'll just use easy big numbers here. If I just said, hey, general living expense, expense adjustment upon the death of a co-client is going to be 50%, then if Luke were to die next year, this would drop down to $4,000 for the surviving client. Again, this is not the right setting for everybody. Again, I have seen advisors just turn that off and they kind of just handle it themselves. That's totally fine. That is absolutely something if you want to do it. However, this tends to be just a very invasive way to set up something like that. You don't have to worry about it. It just kind of automatically takes care of itself. Obviously, you might have other goal cards and things like that you have to adjust, but you don't really have to worry about the living expenses being way too high for what they are. So again, nothing too extreme here, but just making sure that's kind of built in, make the overall process a little bit smoother. Now, this is the real fun one. This is the return model assumptions. So this definitely gets a little bit complicated. This dives into things about like how statistics work in RightCapital, how we calculate things like the model type or the calculation type for the Monte Carlo sims. This definitely gets a little in the weeds here. I will say I did take a couple stats classes in college, but I'm by no means an expert on everything related to these. So please bear with me. This is definitely going to be a little bit complicated out the gate, but we should be able to get through this. So to help kind of explain what these settings are, I am going to be using the Help Center article on this. If you have any confusion on what these are, I definitely recommend checking out this Help Center article first. This has a ton of information talking about where this stuff comes from and why we calculate it in certain ways. So definitely, if you have any confusion, I would definitely recommend starting here because quite frankly, I'm going to be using it for the presentation. It's definitely an easier way to explain how these work. So as it mentions, the return model assumptions at the bottom of the page here allow you to adjust the Monte Carlo calculations within RightCapital. So the Monte Carlo, if you're not familiar, is how we actually calculate things like the probability of success for clients. So if I go over to the retirement tab here, this is how we get things like the probability of success. It's how we get the median ending portfolio. It's how we calculate this confidence graph here with all the different scenarios for the Monte Carlo. So again, it is a very important part of how the system works, and there is a couple of different options in terms of how we can calculate it. The first of which is the model type. So basically what this is controlling is how the Monte Carlo will project market volatility. Now, the two options we have available are legacy and standard. Legacy was the previous model. It uses something called a stochastic volatility model, which, as I understand it, tends to be a little bit more random, right? And then we have our standard Monte Carlo simulation, which uses something called a log normal distribution model. This is a little bit more set up initially, so it's a little bit less random. There's still randomness, obviously. It's still working with volatility. But overall provides a little bit more, as it says, flexibility when setting your asset class returns. Now, very, very, very common question we used to get regarding the return model assumptions was, which is better, right? Should I be using legacy? Should I be using standard? We don't necessarily recommend using either of them. This is a very complex setup here. Again, I am not an expert on either of these volatility models. You can look them up. I definitely did while I was prepping for this meeting. Again, I took a couple classes on stats in college, but a lot of this definitely flew over my head. So again, I can't go super in depth about it. If you are curious and want to want to talk about someone with this in more depth, I do actually recommend reaching out to the support department because they can actually talk to our product team and get a little bit more detail on it if you were curious. Generally, what we say is, first of all, the standard is the default for all new advisors after 2023 because this one is progressively updated. The legacy model doesn't really need to be updated every single year. Therefore, it's kind of just set as our legacy model. What's also important about this is it does actually disable certain options. So if I'm set to something like legacy, it does actually keep me from adjusting things like the asset return assumptions because it's just not really how it works. Usually what I say is if people say, hey, which one is better for me? I recommend you research it. But if you are starting from scratch, it's usually best to just stay with the default, which is standard. Again, you can go into depth on it if you would like to. One is not necessarily better than the other. You can just change between the two of them, see which one you like better. But again, it is very complicated. I would recommend researching more on it if you were curious. If you have any questions, you can absolutely reach out to our support team about it. But again, if you don't really know the difference, I would usually just lean towards it's not worth changing is kind of the statement I go with. Now, there is also the calculation type. Now, calculation type is based on how we will calculate things like future asset returns. This is a little bit less complex. So there's geometric, as it says, the geometric calculation will cause the Monte Carlo simulation to use the geometric mean to calculate the cumulative return over a period of time. This is generally the standard when measuring portfolio performance, right? Factors in things like compounding, interest year over year. We also have the arithmetic. This is definitely a little bit different, uses the arithmetic mean to calculate future asset returns. This takes the sum of the annual return numbers and divides the sum by the count of numbers used. We will adjust the returns by half of the investment's variance to account for volatility drag. Now, that's a lot of buzzwords. Again, to be fully honest with you, I don't comprehend every single word in either of those. Again, I'm not an expert on statistics, but we do include the really important part about this, which is generally the arithmetic typically results in higher returns. So similar to the discussion we had earlier on things like the historical performance returns or the JP Morgan forward-looking assumptions, or excuse me, the historical index returns and the forward-looking assumptions. There is some debate on which one might be better. It kind of depends on your point of view as an advisor. Generally, though, when I would talk about on support, this is the thing I would focus on is like, look, at the end of the day, arithmetic is going to generally result in something a little bit higher. So you are free to use it, but if you see that overall your returns are a little rosy and maybe not what you would call, realistic, you might want to try the other one. Again, neither one is necessarily better. They both have pros and cons when it comes to calculating future asset returns. Nobody has a perfect system for calculating things that haven't happened yet, obviously. But there is some debate on it. Again, what I recommend with this is definitely do your research, see which one you tend to prefer. You can go with that one. And if you have any questions, I generally just recommend reaching out to support. Again, they may not have the answers immediately. They will probably have to talk to someone on the product or the calculation engine team. but we can look into those kind of questions for you. So again, definitely very complicated. I apologize. I can't go much more in depth on it because I just, at the end of the day, do not have enough of a stats background to understand these fully. But definitely something important to mention while it's here. And again, definitely recommend researching it if you have any confusion. Now, that is really it for the base assumptions in RightCapital. Now, again, what I just looked at was the default assumptions for a client plan once you actually kind of get started, right? Now, as you might have noticed, there are a few options in here that are actually grayed out. Now, that may not look, it may not look that way for you on your side. The reason is that my account is actually part of a firm that uses our team sharing feature. I'm not going to get fully into that, but what this effectively means is that the super admin for my team, basically the person who runs the firm within RightCapital for my team, has actually set these themselves and made it the standard for everyone in my team. So again, I'm not going to go fully into everything about team sharing. That's not really the focus of today's webinar. But if you were looking at this and seeing that it's grayed out, even on the asset returns, if you don't have the option to like make new asset returns, or you can't adjust any of the items in here for any of these items, that means you have a super admin on your team who has set them for you. So generally, if you need any of them to be changed or you need flexibility with them, definitely just reach out to whoever the super admin is on your team. If you do not know who the super admin on your team is, you can reach out to support and we can find that person for you. But generally, we just recommend asking your firm first and just trying to check. You're like, hey, does anyone have admin controls for RightCapital, and going from there. But again, if anything's grayed out for you on your screen, you're confused, that is why. Now, we got a little bit more time left here. So while we're here, I do want to dive into a couple ways this affects the client plans. Now, I did touch on this a little bit earlier, but just so everyone's kind of on the same page, I will show how this affects it from the beginning. So again, what I can do, I can look up one of my client plans, open this up, and let's say for this client that the default assumptions I have set up for the rest of my plans does not work for this client. They don't agree with the asset return assumptions for the rest of my plans. They are very cautious about inflation, things like that. They need these to be adjusted on a personal level. So what I can do, if I go to their client plan and then go to the gear icon right here, I can go to the settings menu, and there's a bunch of different options in here for the client. Now, not all of these are return assumptions or the assumptions we looked at, but a great deal are. So to begin with, we have the return assumptions. So I did go over this earlier, but in case you missed it, again, all the return assumptions you can set up in the advisor portal, you do have available within a specific client plan. So for example, I'm using the global assumptions, which are the historical index returns. But if this client needs to see something different, or if I'm looking at it and going, hey, whoa, the historical index returns are just way too positive an outlook, I need to bring that down, I can actually set them to the forward-looking assumptions, which will make their assumptions for things like their large growth U.S. equities, all their different asset classes, a little bit more conservative, bring it down from like 11 to 6.7%, right? So obviously that's a big switch. Again, which one is better for you is not really my place to say. Everyone has a different point of view on this. Again, I have had many, many different discussions with advisors in terms of what's better for them or what's better for the client. It just comes down to personal preference. So I definitely recommend trying out the two of them and seeing which one you like better. Next up, again, you can pull in the custom assumptions we brought in as well. You can also just do household specific assumptions. So if this is the only client who wants specific assumptions, you don't have to go and make a preset. You can just adjust it directly within the plan and save it right at the bottom. Similar to the assumptions page in the advisor portal, there's also a link to the help center right here as well that can kind of help you get some information on it. So if you're confused on like, hey, where do we get the historical index return again? Or where do the forward-looking assumptions come from? Where am I doing with customized return scenarios? Those are all available in here, including doing it for a specific client as well. So again, if you have any questions, I always just defer first to this article at the bottom. All right, next up is account assumptions. Now, this was not in the default assumptions for every plan. These are a little bit more specific. So what these correlate to are two specific settings. The first is based on the account type, what % of the account should automatically go to the co-client? This is more worried about estate planning. It's not the biggest issue in the entire world. Not everyone adjusts these. But what it's really saying is like, hey, for this client, when they pass away, what percent of each account type should go to, to the co-client, and what percent should, go to their kids or out of estate, basically, right? Which should automatically just go, outside of the plan. Now, this isn't the only way you can set this up. If you have multiple 401ks, you can adjust like where those accounts will end up going in a different way. That is possible. You can liquidate the account and then gift the money if you need to be more specific. This is just kind of a general assumption saying like, hey, across the board, doesn't matter how many 401ks they have, 50% of that money will go to their kids instead of their spouse. That's it. It's just a quick and dirty way to make sure that like, hey, if most of their, brokerage money shouldn't go to their spouse, how do we just set that up without having like three different cards? It's not for a specific account. You can just plug that in. You're done. We also have how RMDs are calculated in the first year that RMDs occur. Pretty simple. It just means like, hey, when we calculate RMDs in the first year, are we doing it based on the current value of the account or the year-end value for the account? This setting does not come up a lot. This really only comes up if you have people taking out RMDs this year, like the first year in the plan. So if you work with pre-retirees mostly and you don't, RMDs are further down the road, I wouldn't even worry about the setting. It's not going to do anything. But if you have people that are currently taking RMDs, this setting does matter. Maybe not by a lot. It's really usually only going to, adjusted a few $1,000s one way or the other, but it just makes sure like, hey, if we're starting RMDs right now, are we tying it to the current value or what it should be at the end of the year? That's basically it. Next up is the tax assumptions. Now, again, these do not have defaults in that other assumption tab. I will just go over these very briefly because this is specific to each client plan. These include things like ordinary income tax rate adjustment. So it's just trying to show like, hey, should federal ordinary income tax be increased by a specified percentage by a specific year? So if I go in here, I can make sure that like, hey, starting a specific year, the ordinary income tax rate actually adjusts a little bit higher. Again, I don't see a lot of people touch that very often, but it can be important. We have things like the portfolio turnover, which is just an assumption saying like, hey, every year, what percentage of the total portfolio should kind of be quote unquote turned over, just like normal buying and sell process. So again, usually we just keep that at 5%. The only reason I see this changed generally is if someone has hundreds of millions of dollars and that 5% is actually an extreme number and needs to be toned down. Again, though, generally 5% works for most people. But if you need to adjust that every year, that is important. Also, by the way, one of the number one culprits when you see capital gains in a year where you're not selling anything, it's because of the portfolio turnover. So something important to keep in mind. Next up is qualified dividends. Pretty simple, just what percentage of dividends are assumed to be tax qualified. Again, I don't see this adjusted very often, but that option does exist. And then we also have long-term capital gains. Again, just what percentage of capital gains are assumed to be long-term capital gains. I've seen this increase to 95%. I've seen people just increase it to 100 and say that, they never adjust anything or take anything out if it's not long-term. Again, there's some personal preference there. Our default is 90. There's also a ton of different options on capital loss carryover. We do break it out by client and by asset. So we have a difference between cash, appreciated assets and AMT credit. So if you need to adjust those options, great. There are options in here for that. Otherwise, I don't see it being used very often. We also have options for previous MAGI values or modified adjusted gross income values. This is important for things like Medicare premiums and student loan calculations. Typically, this is important when someone is taking out those premiums, you're paying those premiums now or paying student loans currently, just to make sure that we can do the 2-year rollback. But if someone is starting these later in the plan, like if they don't need to worry about Medicare premiums for another 20 years, these settings aren't really going to do anything. That's about it. Now, moving on to other assumptions. Now, some of these will be familiar. So these are the inflation assumptions we saw from earlier. Again, same thing. If you want to adjust the general inflation for a specific client, this is where you're able to do it. Again, I have firm controls enabled. My super admin has these set, so I can't adjust them. But if you were going to adjust inflation assumptions for a specific client, this is where you would do it. No, this is definitely a complicated one. This is Social Security assumptions, specifically adjusting benefits or discount rate. Now, for adjusting benefits, we can reduce them in the future. So if someone is worried about Social Security benefits being reduced later. So, for example, if they're one of the people that say like, hey, I just don't think Social Security is really going to be around that much in a few years. I think like at most I might see like, 80% of my total, excuse me, Social Security benefit getting paid out. You can set that up here. Again, not everybody needs this setting, but if you have someone who's worried about that, you can set that up here as well. We also have options for a discount rate. So basically just trying to help factor in things like what is the opportunity cost of asset returns if I take something earlier. This can help you kind of dial that in. Again, for sake of time, I got to keep moving here, but those options are available. I definitely recommend if you have questions on this, definitely check out the Help Center, definitely speak with a support person. I rarely ever saw these settings come up, but there are options. And at the very bottom, we've seen these already. These are the miscellaneous assumptions. So again, the cost of purchasing, selling, a real estate property and expense adjustments, again, can be adjusted for a specific client, but you obviously do not have to do this. Again, mine are blocked out because of firm controls, but those options do exist if you need them. And that will really do it for most of the assumptions for today. So again, just to kind of quickly highlight some things that we went over today. First off, we looked at the general assumptions page over in the advisor portal. Again, what this controls are the defaults effectively for all assumptions within a plan. This controls, very importantly, what the total, interest, dividends, capital gains, return, and volatility will be for asset classes within the system. So when you apply something like a model portfolio to a client's investment account, how are we actually getting things like the returns for that? Instead of just marking them, we can mark something as large growth, but what does that actually mean? This is where those numbers come from. So obviously a super, super important group of settings. It is actually one of the first things we talk about in the Creating Your First Plan webinar. It's definitely one of the first things you should ever look at. Now, I do actually want to mention these were just updated for 2026. So I believe 2 weeks ago, we just updated these. So they are accurate to 2026. Again, if you're not happy with them, you can actually go in and make some small changes for yourself. If you're someone who says like, hey, this should be 9% return for large growth, great, no problem. You can go in and set that up, but just something to keep in mind. Next up was inflation. Again, very simple, just covering things like what the general inflation rates will be across the system. How are we increasing expenses over time? We've also went over quickly the settings to control whether something should inflate before its start date, depending on where it was created. And lastly, we have miscellaneous assumptions. We went over things like the cost of purchasing or selling a real estate property, the automatic expense adjustment upon the death of one of the clients, and then the return model assumptions. Again, I know these are very complicated. Most people don't really worry about these settings, but if you do have any questions, I definitely recommend checking out the Help Center, doing a little bit of research. And if you do have further questions, you can leave them in the chat here, but I also just recommend reaching out to support, especially if they're very in-depth questions. We can actually just reach out to the product team and the calculation engine team or the calc team and just get the answers directly from the source. So again, if you do have any questions, I do recommend looking into it, but generally, you don't need to adjust these. It doesn't have a massive impact on the plan overall. Lastly, as we just looked through, we did look at the options for adjusting these within a specific client plan. Again, the place to do that is you go to the gear icon in the very top right of a client plan, go to settings, and adjust them from here. So again, even if you have one client that doesn't follow the rest of the pack, they do not want the same assumptions that the rest of your client base uses, that is totally fine. You were able to adjust these settings specifically for each client. And again, just because I adjust them here does not mean it is affecting anybody else, right? They have household specific assumptions. We can use one of the other defaults. This does not mean we're changing it for every client. So you can do this on a client by client basis if you really wanted to.